Hi, everybody. Welcome, welcome, welcome to this webinar. It's really good to see everybody here. Um, Thank you for joining us. If you don't know, this is your first time joining us on a webinar like this, my name is Mike Suprovici. I am the head of acceleration here at Decile Group. Decile Group is a company that's trying to improve the venture capital ecosystem. We do so in a number of different ways. We have an accelerator called VC Lab that has launched 475 venture capital firms to date. We've done this all over the world. And one of the neat things about that is that every single one of these firms has taken what's called the Mansarius Oath, which is an ethical code of conduct. And so hopefully as a result of this action, we're going to see a lot more ethical like venture capitalists be launched worldwide, and we're super proud of that. In addition to that, we built a lot of tools, systems, and things like that, which we can sort of cover later to help new and emerging managers scale, including our Decile Hub platform, which has become basically the operating system for emerging managers, and a variety of other factors, including a fund of funds and things like that. So that's kind of what we do. A little bit of background myself. Prior to co-founding the Decile Group together with the Deo Resi, I was running all of the portfolio success initiatives at Founder Institute. Together with the Deo, I raised 14 funds. And even just within the accelerator experience here, I've helped literally hundreds and hundreds of new and emerging managers raise their first funds, second funds, and third funds, and so on. So I'm more than happy to sort of just kind of spend this next hour with you answering any sort of questions that you have about the venture capital industry, the business, the strategy, anything that you sort of have on your mind. If this is your first time attending one of these events, there's a webinar chat on the right-hand side. You can, post, introduce yourself there. You can say your name. Just be careful mentioning what you're actually working on, okay? Do not talk about like your fund, what your fund is doing. This is a public webinar, and there's serious general solicitation rules that that you shouldn't be breaking, right? You're basically breaking like the law when you sort of talk about that you're raising this fund that's doing X, Y, Z. That's not something that you should be doing. But you can say, hey, my name is Mike, and here's my LinkedIn, and that's fine. And that's what the chat is all about. If you have questions for me, there is a Q&A button at the bottom of your screen, and you can add questions into the Q&A, and you can upvote them, right? And I'm going to be prioritizing a lot of those questions in today's kind of hour with you about anything that you sort of have here. So, just wanted to make sure that that's out there. So if you have questions regarding like venture capital or anything like this, basically that's what this hour is going to be about. Okay, it's going to be about like VC, it's going to be about like launching funds, strategy, anything that you sort of have that's on your mind. I'm more than happy to go ahead and cover with you. Okay, so just sort of wanted to put that out there. A couple other kind of housekeeping items, and then let's go ahead and roll, right? Let's go ahead and start getting your questions in. I really want to sort of focus as much of this on kind of like raising funds in this current environment. Right now, there's a lot of what I would call like misinformation that you're seeing a lot in the media. So for example, there's like a lot of negativity and things like that in the press about the kind of like what's going on with new and emerging managers. You're seeing this with people on Twitter and stuff like that. We're not seeing any of it. Okay. I just want to kind of put that out there. We're seeing like record numbers of funds closed, record numbers of people money closed, and things like that. And this is happening all over the world. Okay. We've launched, 66% of the firms that we've launched are outside the United States. Okay. So, we're not seeing a lot of this. So just wanted to go ahead and put that out there. And, everybody generally will say, hey, well, it's not like this in Europe, or it's not like this in like whatever, Africa or whatever. And I have a lot of empathy for that, just because, again, I work with managers all over the world, and I know that there's certain things in each region that might be slightly different, but that still doesn't change the fact that people are closing funds faster. And certainly they do so well within the VC lab kind of methodology and way. So let's talk about that methodology really quick. I'll give you a sense of kind of what this looks like, and then just so everybody knows, we do have admissions open for the next cohort of VC Lab which is VC Lab 15. So what is VC Lab? VC Lab is an accelerator. Think of it kind of like YC, but for venture capital. It is the premier way to start a new venture capital firm to date. Okay. It is a closing program. So you're going to go into the program and you're going to close a fund. It's not a learning program. It's not like, a place where you can sort of learn about venture capitalists. This is a program for founders of venture capital firms. Okay. So if you want to go out and as a next step in your career, you want to launch your own venture capital business, VC Lab is incredibly effective at helping you do so. Just to give you a sense of kind of how effective this program has become, it takes an average of 12 to 18 months for people outside of, let's call it the VC Lab ecosystem, to perform what's called a first close. So this is the first money in to a fund. 12 to 18 months, this is pretty normal. And that's if you're successful. Most people fail. So I just want to put that out there. Most people do fail. For VC Lab alumni, right now it's 5.8 months. Okay. And the reason for that is because we're on, cohort 14 now, cohort 15 starting, right? We run the program 4 times a year. So it's just like a product, right? We iterate and improve the curriculum, improve the process and things like that. We adjust the curriculum every single week to make sure that we get you to where you need to be to basically close on a fund. So if you sort of like suspend disbelief, trust the process, and so on, you can be just like the other 475 or 77 now firms that we've launched over the last 2.5 years globally. The methodology works. It works everywhere around the world. And so if you sort of just like work with us, trust the process, it's a very, very effective program. But I want to be clear, right? It's for people that want to launch VC firms. It's not for folks that, kind of want to like experiment with like a fund. They want to run a syndicate on the side. They want to kind of like are employed by somebody and they want to launch a fund under that umbrella. That's not a very good fit for that. It's for like founders of VC firms. So if you're thinking about applying, again, applications are now open. I suggest that you apply early if you can. Last cohort, we had 3,000 people start applications. So, and we can only maybe accept, maybe 10% max, right? Otherwise, it's just the quality of the program starts to degrade. So want to just put that out there. Apply if you want to start a VC firm. This has become the most effective way to start a venture capital firm worldwide. I see that there's some questions coming in, so I'm going to hop in on this and give you some thoughts. And if you have additional questions about anything, right, like process, fundraising, that kind of stuff, add it into the Q&A. There's a question here from Sergey. We're thinking to add a valuable venture partner to our team. The issue is that he holds a Russian passport. At the same time, he is entitled to a Kyrgyzstan passport. Would you recommend that he gets a Kyrgyzstan passport, or can we keep him with the Russian passport given the current situation that we have right now with regards to sanctions and stuff like that? I'm just paraphrasing, Sergey. Look, I cannot give you advice on that topic on a public webinar, Sergey, right? Like sanctions are set up in a certain way for a reason, right? And it's not, it's like me answering this question is like saying, how do you optimize around sanctions so that you can get what you can get done? Like I can't do that in a public webinar, dude. Like that's pretty complicated. I do want to say though that on a high level that it's really, really, the sanctions are getting more and more severe, right? Because there's, let's call it for what it is. They haven't been as effective as, people wanted them to be. And as a result of that, sanctions have sort of increased. And so, anything, whether it's like a, like a passport, emails, or other thing, generally will become an issue with the banks, and because banks are very conservative, they just don't want to deal with the drama, right? And so just know that that is a real problem right now. Joe, I see that you're asking a question in the chat. Put that into the Q&A. There is a Q&A at the bottom of your screen. And then you can go ahead and upvote stuff. What is the difference between Venture Institute and VC Lab? Do you suggest we do one before the other? Good question, Alexandra. So VC Lab is a program that's going to help you launch a fund. Like you're going to close a fund, and that's going to be the number one criteria. So let me just kind of give you a sense of like the pace and the speed of the way things are going. So cohort 14 right now is running, Alexandra. Okay, and it started 4 weeks ago. Everybody that's getting to what's called the thesis review right now has to have signed letters of intent from limited partners that they're going to invest in their fund. Okay, that's the speed, right? This is a closing program. You're going to close the fund, okay, or at least do a first close of the fund by the end of the program, which is 12 weeks, okay, 14 weeks, right? And so this is a closing program, and so if you're going to join this, then you should go out and try to close a fund, right? It's not really for folks that want to sort of experiment or whatever. Now, it's really good at helping people figure out if this is what they want to do with their life, and that kind of stuff. And so, some people think that they can raise it. They go out, they try to get secure interest from limited partners, and they fail. And they're like, wow, that just saved me like 6 months of time that I would have wasted doing this. And clearly my thesis is not working. Okay. What Venture Institute is, it's exactly the opposite. It's a program to learn, right, about venture capital, how it works. And it's primarily geared to people that want to sort of support funds like associates, venture partners, and things like that. And yeah, it's true that we do have some people in the Venture Institute that do the program, learn all the ins and outs of the Venture Institute program, and end up, then applying to VC Lab. And we actually have a couple of situations right now where those folks have closed the fund. So that's definitely available if you want to do that. So go ahead and apply. And the way Venture Institute works is that think of it, it's kind of like 8 weeks of curriculum to learn about venture capital and kind of the ins and outs of that. And then, the top participants get an apprenticeship in one of the top firms that we manage with our Does All Partners initiative, right? So then, you get to actually get some work experience as well. But it's primarily geared for people that want to basically work in venture, not necessarily founders of venture capital firms. Question from Jeffrey here, so from Jeffrey, may both emerging fund managers go through VC Lab? So it's a really good question here. You really want to have your all of the managing partners join the program if they can, Jeffrey. And the reason for that is that the program stress test is your relationship. And what you don't want to do is you do not want to form a fund with people that you maybe don't know well or haven't worked on a project or something, a big project or lots of stuff together for a long time, because this isn't like starting a startup where you have like these nice like sort of vesting schedules and things like that. You're owners of this thing, okay? And if one of you leaves, okay, the whole thing basically falls apart. And you're managing people's money, right? So it's a huge responsibility, right? So you want to make sure that before you form a fund and all this other stuff, that you stress test your relationship. And VC Lab is really good at that. I had an office hour, on Friday with a person that ended up withdrawing from the program, and he was thanking me profusely for it because basically him and his partner realized that this is not something that they can do together. And so it saves a lot of time, and heartaches, lawsuits, and all sorts of weird stuff, right? And I'm going to go on a slight tangent here. So everyone, if you're like on this call and you're not in one of our cohorts or are considering kind of applying to a future cohort, look, this industry has a lot of like aggressive vendors out there that are selling services like fund admin, lawyers, and all that kind of stuff. If anybody is kind of reaching out to you about that, just say no. the difference with the VC firm versus like a startup is that the last thing that you do is incorporation, not the first thing, right? When you start a startup, you go do your thing, whatever, Stripe Atlas, use a law firm, whatever. Now you got to start up. That you can't do that with a VC fund, okay? Because you might have limited partners that say, I don't want you to be in Luxembourg, I want you in Delaware, right? And now you got to redo everything. And there's very few people that know what they're doing in this very specialized industry. And as a result of that, it's very expensive to sort of set things up correctly. So this is the last thing that you do, right? So if you're kind of on a call right now with some, salesperson or something, just cancel it, okay? This is the last thing that you should do. Do not start anything related to administration until you have at least 1 million, if not 1.5 million, hard circled via letters of intent from limited partners, like signed, okay? We call those pacts. And if you don't know what a pact is, it's basically like a kind of like a non-binding letter of intent where the limited partner says, hey, I'm in for $500,000 or I'm in for $100,000. And that allows you to sort of like reserve their position in the fund, okay? Happy to talk about pacts later and how to get them and all that other stuff. But, we did do a webinar on how to close these pacts. And until you have 1 million to 1.5 million minimum, that's like the minimum, okay? In signed letters of intent, you're not ready to talk to any vendor. And what you're doing is you're creating you're spending time on things that seriously don't make any difference at all. And if anything, they can actually hurt you because you might actually commit to working with somebody and you might have to throw all that away, okay? And we've seen that. We had in every cohort that we run, we have a number of people throw away hundreds of thousands of dollars worth of legal. Think about that. Could you imagine spending $100,000 and making it like, throwing it away? Pretty bad, right? Like, so like, don't be those people, okay? Could you please discuss not so obvious career paths within VC industry, potentially for folks with an MBA? Would you say that constantly developing tech, shifting market tactics, new generation entering a workforce, has anything changed or expanded a career path in the industry? 6 specific examples would be highly appreciated. Yeah, it's a really good question, Mingle. Look, breaking into venture capital is like one of the hardest things that you could do, which is why we're doing this Venture Institute, because we're trying to actually open up this whole industry. But it's basically been an industry that's been primarily, led by a very few kind of firms with terrible like succession plans, okay? And as a result of that, it's just really been incredibly difficult to sort of break in to VC in any sort of capacity, okay? But something has changed in the last 2 years that is making this what was basically a daunting thing, which is why people would just not even spend any time doing it anymore, because it's just like, I'm not going to spend 10 years as an associate before I get promoted to principal, right? Like, it's just like, people wouldn't do that. So what has happened though is that there's been kind of like a Cartesian expansion of what are called new and emerging managers. These are like new VCs that are being started. And it's happening everywhere all over the world. Like I said, just within our own ecosystem and our own program in the last basically 2.5 years, we've launched 475 new VCs that weren't available before. Okay. And these VCs are small, they're nimble, they're very missionary in nature. They typically are funding a lot of things that matter. And the opportunity for people that want to break into venture, and again, I'm obviously very biased because this is what we do. But the way I see it is the opportunity is there. Why? Because a lot of these firms are like not that different than the startups that they're funding, right? They're just getting going, right? You're kind of able to get in at the ground floor. In 1.5 to 2 years, they're going to raise another fund, and then the opportunity for career expansion is quite significant. So if you can, if you can help these managers, right, knowing that these are smaller funds, they won't be able to sort of maybe offer like market compensation or whatever, just like a just like a startup wouldn't be able to, right? And you sort of get in at the right time with some of these folks, especially the folks that are performing well. You have a pretty wonderful opportunity to sort of shortcut this process that if you were to sort of go to like a very large VC firm, and if you were to get a job, which is incredibly hard to do in the first place, you'd be stuck in basically an associate role with no carry compensation or anything like that for 5 to 10 years, right? Before you can move up to principal, before you can, even have a hope of getting into like a general partner, right? So what I would do if I were you is I would start thinking about like the areas that you're passionate about, because what happens is that all new or a lot of the new VC funds typically have a very focused thesis. Okay. They don't just like fund anything that they see. They're like, oh, I'm going to invest in clean tech, in the Midwest in the United States, right? Or whatever. Like they're generally very focused, and that's how they're able to sort of stand out, because they're so focused, right? And so if you can find a thesis aligned firm, and you sort of offer to help, even if it's like in a part-time capacity in some way, I'm sure that many of them will gladly accept that. And that's why we have this Venture Institute program in the first place, because we sort of shortcut that, right? Because we give you all the information and knowledge so that you can actually contribute to a VC firm very fast, right? 8 weeks. Then we actually place you for an apprenticeship in a VC firm that is powered by us. So we know that they're super safe and are running things correctly. And, you're not going to have a Bernie Madoff situation or something like that, right? And then, if the apprenticeship works out, maybe there's opportunity for future career growth within those firms, right? So we sort of help you kind of do that, just systematically as well. Do you think it makes sense to have part of the fund dedicated to opportunities, example, investments out of the target stage? If yes, what should be the percent of the opportunity fund compared to the total fund? Claudio, another way to sort of think about this, Claudio, is it's on thesis versus off thesis. Okay, that's probably how I would sort of reframe this. So if your fund is a pre-seed fund that's investing in companies I'm making this up, in like Brazil, focused on fintech, okay, that's your thesis, then that's where you're going to spend. You're going to do 80% of your deals. Okay. Then you have 20% of the fund available to do things that are sort of off thesis. Okay. And that is how it works across the board. There's a venture capital exemption that actually forces this. It's like an 80-20 rule. So you can't, invest more than 20% of your fund off thesis. Right. And so what you sort of want to think about is like, what's the thesis? Right. And then you're going to have 20% available to do things that are sort of off thesis. So hopefully that's helpful here. What is the average size of a first fund? What is the minimum size of a first fund to be effective? From Joe. Yeah, so really good question, Joe. I would say globally, it's like 10 million. But, in emerging markets, they're a lot smaller, and in developing markets, they're bigger typically, and so it's a hard question to sort of answer in a vacuum. But what we're seeing for a new first fund in like an emerging market is like, 2.5 to 5 million is pretty normal, and in a developed market, you're seeing, 8 to 15-ish, right? That kind of type thing. But it doesn't really matter, everyone. What you want to sort of think about with your first fund is that it's like a minimally viable product, an MVP. So the second part of your question is actually what's the most interesting part, is like, what's the smallest fund I can do to sort of make this work and get going? Because, most of the iconic firms that you know of all have had really small fund ones, first round capital is $4 million. Felicis, I think Felicis now has like billions under management. Their first fund was like $4 million with maybe five. Lowercase Capital, which is like the best performing fund of all time, I think at this point. It's like 6 or 7, it's like 7 million, initialized with 6. Okay. And these are in developed countries too, right? These are all like US funds, you know? And so it kind of it doesn't matter because that's like your MVP where you prove yourself. You now all of a sudden have a track record, and then you can go on to fund two and raise much more money from professional, like limited partners. And so it's better to have a small fund one. You're going to have way more assets under management faster with the small fund one than if you go out and try to raise $50 million like right now. Okay. For the math to work, right? So you're going to charge 2 and 20. So for everybody that doesn't know, 2% management fees, 20% carry, right? So for the math to sort of work, where you're not just taking so much of this fund in fees versus deployment capital, 2.5 million is generally the cutoff. Below 2 million, it becomes really hard to sort of run a fund properly. But you have to run a fund properly in order for it to count as a fund one. So a lot of people make this mistake. They're like, well, Mike, why don't I just do like a multi-asset SPV or something like this? It's because like limited partners, okay, will not like look at that as a fund one. So now you're back to square one, right? So you sort of want to make sure that you're at a point where you can raise a proper fund one, that you can show that you have an institutional like process, even though it's only $3 million or whatever, so that you can move on to fund two and raise 15, 20 or whatever number is. Okay. Everyone, if you tune in a little late, there's a Q&A button at the bottom of your screen. Add questions in there, upvote them. I'm going to try to start focusing on the ones that are the most upvoted, but I'll try to get to everybody. What are some tips, best way to get ahead in joining a VC fund as an associate? Yeah, so the best associates typically are very independent and are able to sort of, clear the way for the managing partners, right? If the managing partner has to like micromanage you, it's going to be hard for you to, like do well and, eventually get promoted and things like that. So the first thing is you need to have sort of like a take charge, kind of like, go take the bull by the horn attitude and try to go do things with minimal guidance, right? Second, you're probably, a lot of people will leverage an associate for a lot of like analysis and things like that. And so you got to be pretty good at that. Like if they're going to want you to do research, boom, you got to do research. They're going to want you to find 150 LPs for them, go find 150 LPs. So you got to be like really good at doing that kind of stuff, And then finally, a lot of associates kind of have this point of view that, they want to be in a fund because of all the sexy stuff, which is like investing in companies, right? But just know that like 90% of your work is not going to be that. Okay. And as long as you come in with that attitude, right? Or maybe 80%. Okay. Maybe I'm exaggerating. But as long as you come in with that attitude that like, yeah, you might spend 20% on working on deals for people, but like the other 80%, you're going to be basically taking out the trash. Okay. You're going to do really well. And eventually that ratio is going to change for you. Right. And so just come in with the right kind of expectations moving forward into a fund. When is the next cohort of the Venture Institute? The last one was April 9th. Good question, Deb. I don't have an answer for this, unfortunately, but we're planning to do one, I believe, in the fall. So this one will kind of get us through the summer, and then the next one will be in the fall. Do you see a higher success rates of funds that raise for later stage funding versus earlier stage funding? Example, Series A versus like venture studios. No, it's the exact opposite, Alexandra. Like most people can't just go out and raise a Series A or late stage fund. Okay, especially people that don't have experience working a lot in venture, which is by definition pretty much everybody, because like I said, there hasn't been very good succession planning. So there aren't that many people available at these other firms, working at these other firms that are saying, hey, I'm going to spin out and go out and raise my own venture cap and start my own venture capital firm. And a lot of those folks typically struggle to do that. If you just sort of think about this operationally, I just gave the previous person some advice on kind of what their life's going to be like. You're like a general partner at some very fancy venture capital firm right now. You're doing really well. You get to have like vacations and stuff, it's pretty nice. And you spend most of your time, 90% of your time investing in companies, which is super interesting, right? You go out and start your own VC firm, it's like the exact opposite. Okay. You're going to be working 100 hours a week, just like the founders that you're backing, because you're now a founder of your own VC firm. You're going to be spending 60 to 70% of your time on fundraising and operations versus either doing that and investing. And it's just not for the faint of heart, right? And you're not going to make a lot of money initially, right? Because you're not going to have, you're going to have a tiny little fund to start. Like we just talked about very small fund sizes with the previous person, right? So it's just going to be, so it's just, so, but that's the profile of the type of individual that may be able to go out and raise a Series A and Series B round. Like, so like when you're late stage, you're sitting on boards, right? So you have a lot of experience that you're deploying a lot of money, right? Like millions of dollars into companies. And so like the kind of individuals that even have the experience to get LPs to believe that they can do this again are typically the folks that are spinning out. And there's just not that many of them spinning out, nor that many of them that want to start their own firm. So if you sort of think about it, by definition, most new VCs that are getting started are going to be pre-seed and seed investors, because they're going to have tiny funds, right? Like $10 million funds, like that's like a Series A for a Silicon Valley company at least, right? And you're going to need to make 25 investments to make sure that you have the right diversification, right? And so by definition, just from a check size perspective, you're going to be primarily pre-seed and Series A. All right, question here from Regina. What advice do you give for aspiring solar GPs who are applying for VC Lab? Any tips on how to make the application stand out? Well, the biggest advice I'd give you, Regina, is that you should sort of lean into being a solo GP and not have any worries about it. 66% of alumni are solo, okay? There's actually a bigger risk with teams than there is with the solo GP, right? Because like basically the risk with like a solo GP is that there might be like a health issue. It's like the hit by the bus kind of issue. Whereas and that, the probability that is like just incredibly low. Whereas the probability of a team breaking up is incredibly high. Okay. And so, like that's why most new firms are started by solo GPs. And in doing so, you can actually test people out and put them on the partner track for like fund 2, fund 3, using venture partner agreements and things like that. And eventually you can kind of build out your team this way. And so just lean into it. This is great. You're going to do well. And you probably have a huge advantage because you don't have to, you can make decisions a lot faster and stuff like that. So I would say that the downside is that there's obviously more work, right? Just because everything's on you and you can't really delegate the work. And so I would say that's the biggest kind of like thing that you sort of have to worry about, but it's not that significant. It's not that significant in a way, because even if you do have a team, you all still have to do the same kind of work together, especially in VC Lab, right? Because we're making you do that to make sure that the teams work together and they're able to be at the same level of knowledge and stuff like that. So I wouldn't worry about that. Okay. Then the biggest tip on the application, look, one of the biggest issues that we see in applications is when there isn't like a, I don't know, GP market fit, GP market fit, if that makes sense, or thesis market fit, GP thesis market fit, maybe. So I don't know, sometimes I'll see somebody say, hey, I'm going to launch this like fund that's going to invest in crypto or whatever. and you look at their background and all they've done is invest is you know, healthcare stuff, you know. We had a person, Midas list investor, okay, Midas list in the program, okay. They wanted to raise a clean tech fund, right? But all of their experience was like kind of B2B SaaS. And they couldn't raise the fund. Midas list, right? Like, so I mean, you know, like just think about that. So you want to make sure that, you know, you have you know, the right like what you're working on fits what you've done in your career, right? It's like things that you've done in the past, right? So that's like the biggest issue that I would see in like a application, you know, is like, why is this person even trying to do this thing? It doesn't make sense. Okay, so that's one. The second thing is, look, VC is like a network business. Okay, you won't be able to raise the fund if you don't have a big network. You won't be able to like help your companies raise additional funding if you don't have a big network. You won't have enough deal flow if you don't have a big network. Most of the first fund, Regina, is going to be raised from people that you sort of know, okay? And I'm not saying friends and family, but like, you know, first degree connections kind of thing, maybe second degree. It's super unlikely that a random individual that doesn't know Regina is going to go out and say, hey, I'm okay with you, you know, you managing my money for the next 15 years of my life, even though you've never done this before, right? It's just that's like a pretty big ask for somebody that doesn't know you. And so generally, you know, you're going to raise this from people that you know, okay, or at least most of it. And then once the people that you know are in, they're going to, you know, introduce other people that they know, and then they're going to come in because they trust the person that's in, and you're going to get network effects, right? And so one of the things we look at very seriously is like, how big is your network, and are you able to kind of get to the level of you know, people that you're going to need to get to in order to close the fund, right? Because again, we're, you know, you're going to do a first close here in like, you know, basically 6 months post starting the program. Okay, so that's pretty fast. Okay. What advice would you give for a successful fundraising closing of the fund in an emerging market? Grateful for your advice. So the best thing that you can do, Grace, is that you use what's called a pact. And maybe we can put the link into the pact for the pact into the chat here. Okay. So what happens a lot, and it's not just in emerging markets, but this is especially true in emerging markets. There's this phenomenon in fundraising called LP love. So there goes something like this, like LPs likes Grace, likes your thesis, likes everything you're doing. They're like, I love this, I love this, I love this. Yeah, let me talk to my friends and I'll come in and, you know, let me just think about it. And you're going to look at this as like, oh, this person really wants to invest, right? And they're going to just keep doing that for like 10 months and then they never invest. That's called LP love. And this is especially common in emerging markets because a lot of people just are kind of don't feel comfortable saying no. I mean, even in America, in America, we have a pretty direct culture, you know, even in America, people have a hard time saying no. And this is especially true with the bigger, larger LPs like family offices, institutional, and things like that. So what we did is we developed basically what's called a pact. The pact is like a letter of intent, okay, that helps you secure interest from limited partners and allows you to know exactly who to spend your time on, okay? If someone is hesitant at basically signing what's called a letter of intent that's non-binding that they're gonna invest into the fund, then by definition, right, that person is kind of soft-circled and, you know, you will waste a lot of time with that person. Okay. So what you want to do is you want to basically introduce the pact in all of your sort of fundraising conversations to sort of figure out if the person is real or not. Okay. And if the person doesn't sign a pact, then they go to your newsletter and you don't waste any more time. And if the person signs a pact, then you spend all of your time with them. Okay. And so conversations with a pact go a little something like this, and I'll give you a couple cases here on how to sort of deal with this, depending on where you're at in your fundraising process, okay? So if you're just sort of starting out, like let's say you're just considering launching this, you're gonna have a thesis that you're gonna tell people, you're gonna have maybe a catch-up call with like a potential limited partner. You tell them about what you're doing. And if you sense that they're like really excited, so in other words, they're like completing your sentences, oh yeah, Grace, this makes a lot of sense. Like I can see why you're like the best person to invest in, in these AI companies. And I'm just making this up, Grace. I don't know what you're actually working on. Then you say, great, look, as a next step in our process, we're going to send you what's called a pact, which is a letter of intent that allows us to reserve your position in the fund. What did I just do? Reserve your position in the fund. So I just made the opportunity feel exclusive, okay? Like I'm holding them a spot, okay? And it has some light NDA language, which allows me to share more information, such as like our deck and a bunch of other things that we're working on, okay? And if the person's like, like I don't want to like sign this thing, okay, then you sort of know that they're not really that committed, okay? So that's what you would want to do. There's a way to sort of, the agreements, we put those in the chat so you can sort of see it. If you come into the VC Lab program, you're going to get access to Decile Hub, which I mentioned at the top of the call is like the operating system for VC. And you can go ahead and send these out throughout the process, okay? Once you get a little bit farther along, and let's say that you're now, I don't know, let's say you already have like $1 million or $2 million in pacts and you're getting ready to go and get to a first close, your messaging is going to be slightly different. What you're going to do at that point is you're going to say, hey, we have started a closing process. We are now kind of aligning all of our vendors and everything like this, and we should be sending out agreements relatively soon. Can you sign this pact to help me reserve your position in the fund, and so that I can collect all the information to customize the legal agreements for you, right? And now you sort of kind of talk about like the fact that this is happening, you want to give them a custom package and all these things, and the pact allows you to do that, all right? So that's what you do, like kind of like when you're in that strike zone, when you're about to get close to a first close, so like kind of like maybe 800 to 1.5 million packs. That's sort of the ask there. And then the ask with regards to folks that are past the first close and you're going in to go out and start doing like rolling closes or in future closes and things like that, the conversation will be more around like the portfolio companies that you already have because you already did a first close and you've invested. And then you can say, hey, if you'd like to sort of participate in the fund and in the upside of these companies that are in the fund, which many of them have been marked up, can you please, sign this letter of intent? This allows me to kind of reserve your position in the fund and get my fund admin to go out and get you all the necessary paperwork today or tomorrow, right? And so like now all of a sudden you're just saying, hey, this is what the closing process works, and you would go ahead and send that to them. So that's how you handle this. Hopefully this is helpful, but the pact is your best friend, okay? The pact is what allows you to figure out who's real and who's not. And, you're going into a world that's just filled with a lot of, BSers, right? And, a lot of people are going to waste their time. So just use the pact always. Okay. I might have missed this, but it sounds like it's a better way to break an adventure institute if you were close last time, like a finalist. My plan is to create on why I would invest in, say, 50 startup founders I met in the area. Yeah, so I'm not really sure. I'm not really sure what you're trying to do here. My advice to you is that if you're trying to break into into like VC as an associate, then you should apply to Venture Institute. If you want to launch your own fund, like now, and you're going to actually close on it, like you're ready to kind of go, I would go and apply to VC Lab. Okay. You telling me why you would invest in a number of companies is not that important. I need to be able to know that you can raise the fund, right? And that LPs would want to give you money to manage it. If you want to be basically an associate at a fund, that's fine too. Then we're looking for other factors, and the application process looks at those, and we can cover that later if you want. What is the usual timeline for raising fund one to fund two? That's a good question. Well, this is another reason why you want to do a small fund one, by the way, everyone. Typically it's like 18 months, sometimes 24, sometimes 3 years. So if you actually are one of the people that can actually possibly raise more, just know that that's going to delay until you get to fund two. So every single limited partner agreement, so they're called LPAs, has a clause, and it's called the successor fund threshold. And it basically says something like this. You need to deploy X amount of capital before you can start raising the next fund. And the standard value there is 70%. And if you think about it, it's super fair, right? Like if you invested into my fund and, as soon as you invested, I went out and tried to start to raise another fund, instead of taking your money and spending it on companies and putting a lot of work and managing that money, you'd be pretty upset too, right? And so, it needs to be balanced, right? It's natural for people to sort of like start a fundraise for a new fund while, they're kind of like most have deployed quite a lot of the capital on the first fund. But, there's a limit there, right? So 70% is about right. And so if you raise a $10 million fund one, Alexandra, you have to have invested 7 million of it before you can raise fund two, okay? And so, typical investment timelines in most LPAs are like 3 or 4 years. Some people are 3, some people are 4. But with fund one, like I said, it's like an MVP. Your job is to get that done and get it out of the way with, so you can move on to fund two as quickly as possible. And then you're no longer considered a new manager, okay? When you're in fund one, you're considered a new manager by limited partners. And that means that most LPs just would, most LPs will generally don't want to invest in new managers. As a matter of fact, most institutions are prevented by charter from putting money into new managers because, again, like new managers sort of don't know kind of the ropes. They don't know how to kind of manage their stuff. And so they don't want to invest in new managers. So you, by definition, the type of LPs you're going to go after are going to be very different than what you can now go after in fund two, and especially in fund three, right? In fund two, you can start targeting more family offices and bigger ticket LPs than say like just the classic kind of high net worth individuals. And in fund three, like, now you can really go after these institutions, and now you have 2 funds of track record with deal memos and things like that you can actually use and actually be able to pass diligence, okay? But typically, Alexandra, if your fund one is relatively small, like 5 to 10 million, most people are able to get to fund two in like a year and a half. How do you recommend a new VC stand out in the LP deck, given there's no previous track record of making any investments? James, we've helped, like I said, hundreds of people raise funds. I'm just like trying to think like who was really successful while using a deck, and I honestly have a hard time. I can't even think about it. I don't even know. Like most good fundraisers don't use a deck. Just want to put that out there. It's, you need to have a deck to maybe send it out afterwards or something like this, but you're not going to get a pact with a deck, right? You're going to get a pact in a conversation like this, and usually on the first call. Sometimes on the second call, but generally first call. So you're going to get the one call pact in a call like this. So it's not really about the deck, if that makes sense. It's about your thesis and your secret sauce. If you haven't seen the thesis pre-curriculum that we have, go to govclab.com And there you'll see kind of how to think about building out your thesis. And there's this concept around a secret sauce about like why James is uniquely qualified to overperform as a new manager. And sometimes that's, what you've done as an angel, if you have that kind of track record. But a lot of times it's your network or your advisory track record or other things that make you uniquely qualified to do really well. So for example, if you're like, I don't know, running a very large accelerator that launches a bunch of companies that are really good on thesis, some of them have been, unicorns or whatever, you're going to be able to raise a fund, even though you might have not invested in those companies personally. Okay. So, like you got to just show me that you have access to incredibly large opportunities. And then you're sort of like the fulcrum of that access in a way, right? And that's the secret sauce. But go and take a look. Uh, take a look. Okay. And so just make that happen. And everyone, if you're on this call and are considering like applying to VC Lab, don't start building out materials. As a matter of fact, most people that go into VC Lab end up having to throw away all the materials that they built before. Because if the thesis is not right, you can't build a deck, because the deck is an expansion of the thesis. So what you really want to do right now is go through that thesis pre-curriculum, get that thesis to be right, and start talking to maybe some friendlies, people in your network, and see if you can get some pacts. Okay. So, that's something to sort of kind of think about. Could you please share with us about the long-term vision of VC Lab itself? What are some of the big institutional goals that your team is currently trying to achieve? It's a pretty big question there. But the way you sort of want to think about what we're trying to do here is, we want to help the next generation of ethical managers uh, thrive. Okay, it's not enough for new VCs to get launched that agree with the principles of the Mensarius Oath, and they make a bunch of investments that in companies that matter. It sort of doesn't matter, right? What matters is that the performance of those folks is not only like top quartile, but really top decile. Okay. Because you cannot have impact without performance. In order for us to sort of kind of change like the face of venture capital worldwide into a better and more ethical type of asset class that eventually can be accessed by every individual on the planet, right? You need to have, these like new set of ethical managers that are ultra missionary in their approach to be, performing at a top decile level, and that's why the company's called Decile Group. It's called Decile Group because we want to help the best of the best new managers thrive. And we've aligned our entire, business model, as well as success and aspirations around, people being successful. Like we can only be successful if the people that we help become wildly successful. And we're doing that by basically clearing all the barriers to entry to this asset class for everybody here. We're doing this through education with a free program that's the best program in the world at doing that. We're doing the same thing for your limited partners. We have a program called the LP Institute where we're training limited partners how to invest in new and emerging managers, which is really hard to do. Most people don't know how to do it, so that we can fix a lot of your issues with convincing these LPs from investing. We built the entire system and toolset called Decile Hub, so that you don't have to go out and cobble together to stack with like 25 different tools that just don't talk to each other. Right? We rebuilt the entire fund administration process and how that works. Rebuilt all of your legal agreements so that any LP can read them on their own without having to need a lawyer. Okay. You know, even the way we sort of invest in funds is changing, right? So we've become basically like the operating system for venture capital. And now what we want to do is kind of continue to scale that worldwide to the point where any person in the world eventually will be able to sort of invest in this new breed of kind of ethical and inspiring venture capitalists. So there's a question here. Are there any in-person events for VC Lab events planned? Yeah, we tend to do in-person events maybe 2 to 3 times a year in Silicon Valley and more so all over the world. So we're doing that all the time. Is there a disadvantage if you have not been angel investors in the past? And maybe this is the last question here. Not necessarily. You know, it could go the other way too, you know, like maybe you've been an angel investor, but your track record hasn't been that good, or hasn't been that good, especially on thesis, right? And so that can actually be even worse. So no, not necessarily. It really just depends on the person and kind of what their secret sauce is. All right. All right, everyone. So I think we got through every question. Hopefully this was helpful for everybody. If you are considering applying for VC Lab, apply so sooner than later. Again, we get like 3,000 plus applications for this program. And just, you know, like when you put in your application in at the last moment, what ends up happening is that the admissions team, it just has harder time kind of getting through your stuff and giving you the same level of quality of kind of, you know, like look at it, right? And so just apply sooner than later. That way we have more time to sort of process your information. If you're on the call and you're a limited partner and are considering investing in, you know, venture capital funds, we have a program for you. It's called LP Institute, okay? To help you sort of understand how to do this right and go and invest in the best kind of most robust managers, because it's pretty hard to sort of diligence these funds. And then finally, if you're thinking about breaking into venture, we have a program called the Venture Institute. That's able to help you, you know, with breaking into the asset class, learning about the asset class and things like that. So we're kind of really trying to, you know, educate the entire ecosystem to help these next generation ethical managers really thrive. And hopefully you all will join us at some point in one of our programs. All right, everyone, enjoy the rest of your day. Hopefully this is helpful.